Smart money just deployed 7 figures into Virtual's protocol this week, and it's not for the reasons most people think. While traders chase individual AI agent tokens, institutions are positioning in the infrastructure layer, the protocols that enable agent economies to function. At $1.60, Virtual sits above all major moving averages after breaking out of a months-long triangle. But here's what actually matters. This isn't speculative vapor. Over 18,000 agents have launched on Virtual's infrastructure. Agent Commerce Protocol transactions just hit 25,000 per week, and the entire stack, from launchpad to coordination layer to payment rails, is already operational. The technicals are setting up toward $8, the fundamentals are accelerating, and the smart money positioning tells you everything about timing. Let me break down exactly what's happening. Virtual is trading around $1.60 after a volatile journey from $5 all-time high in December 2024 to 40 cents in April. Since that peak, price compressed into a symmetric triangle pattern for months, lower highs meeting higher lows, textbook consolidation. That structure broke to the upside in mid-October, and what happened next validated the move. Price retested the triangle's upper boundary around $1.20 and held it as support. Now we're attempting expansion phase. But here's the context Wall Street actually cares about. Virtuals isn't another AI agent token competing for attention. It's the infrastructure protocol that enables the entire agent economy on Base. Think Ethereum for smart contracts, but Virtuals for autonomous AI agents. Second largest Base protocol by market cap. Top revenue generator among Base protocols over the past year. Over 18,000 agents launched since inception, spanning DeFi entertainment, prediction markets, gaming, and now physical robotics. The technical setup is clean, above all moving averages, facing $1.90 resistance with $3 beyond that. But the infrastructure thesis is what's pulling in institutional capital. Let me show you why that matters. 3 developments in October shifted Virtuals from speculative narrative to revenue-generating infrastructure. First, Agent Commerce Protocol activity exploded. Weekly agent-to-agent transactions spiked to 25,000, up from baseline levels just months prior. That's not marketing hype, that's actual network utilization. Humans pinging agents, agents coordinating with other agents, all settling through the infrastructure layer. Virtuals calls this agentic GDP, measurable economic output generated by autonomous AI systems. Every transaction flows through virtual token economics via fees, liquidity requirements, and ACP revenue. Second, Butler launched as the human-to-agent coordination interface. Here's how infrastructure captures value. You tell Butler you need a flight to Lisbon. Butler queries the Agent Commerce Protocol registry, identifies specialized flight agents based on reputation scores and pricing, locks your USDC into escrow, coordinates job execution, verifies completion through an evaluator, then releases payment automatically with on-chain reputation updates. One user request triggers multiple specialized agents working trustlessly without platform intermediaries or manual settlement. In October, Virtuals integrated Coinbase X402 protocol, enabling agents to execute instant USDC micropayments directly through web requests. Agent-to-agent commerce just became frictionless at the infrastructure level. Third, Base airdrop speculation creates a capital flywheel. Base is officially exploring a token, and Virtuals has positioned itself as a senior Coinbase and Base executive favorite within the ecosystem. Airdrop farmers maximize Base exposure by interacting with top protocols. More users means more agent deployments, which means more virtual locked-in liquidity pools, higher tax revenue, stronger ACP fees, and compounding network effects. The Fundstrat investment case synthesizes the macro picture. Late-stage crypto cycle where altcoins typically outperform, Federal Reserve rate cuts improving liquidity conditions, enterprise AI capital expenditure showing zero signs of slowing. Virtuals owns the entire stack, Launchpad agent framework, coordination protocol, and payment infrastructure. As secular AI trends accelerate toward autonomous agent deployment, infrastructure protocols that enable interoperability and settlement capture disproportionate value. That's the institutional thesis driving smart money accumulation right now. Let's examine the weekly time frame where institutional money makes decisions. From the $5 December 2024 all-time high down to the 40 cents April low, Virtual formed a symmetric triangle, descending resistance meeting ascending support, volatility contracting over months. That pattern resolved bullishly in mid-October with a weekly close above the descending trend line. The critical confirmation came next. Price retested that breakout zone around $1.20 and held it as support. That retest validation is what separates real breakouts from fakeouts. Currently around $1.60, Virtual trades above the 10 and 21 period exponential moving averages. Those blue lines on the chart, and also above the 55 EMA shown in purple. When price holds above all three major moving averages on weekly time frames, that confirms bullish trend structure. The immediate challenge is resistance at $1.90, with heavier supply around $3. That $1.90 to $2 zone represents prior consolidation and will cause friction, but if Virtual clears that level with volume confirmation, the next meaningful resistance doesn't appear until $3. Fibonacci extensions anchored from the $5 high to the 40 cents low provide logical upside targets where profit-taking historically clusters. 1618 extension at $8, 2618 at $12.70, and 4236 at $20. These aren't arbitrary. They're mathematically derived levels where trending assets encounter supply during expansion phases. The volume profile shows point of control at 55 cents, indicating maximum historical volume concentration at that level. If we reject hard from current prices and lose triangle support, 55 cents becomes the high probability reaccumulation zone. I don't view that as base case given fundamentals, but it's the level that would invalidate short-term bullish structure. Fibonacci RSI just crossed from neutral territory into bullish zone with 3 consecutive green candles. That smooth momentum indicator helps filter noise and identify directional shifts. Right now it's confirming buying pressure building beneath the surface. My strategy reflects asymmetric risk-reward. I'm loading between $1.15 to $1.90, that green accumulation zone on the chart. Stop loss is a weekly close back inside the triangle with loss of breakout support. That invalidates the setup for swing trades, though I would maintain a small long-term position given conviction on agent infrastructure narrative. If we close below triangle support, I'd look to reaccumulate around 40 cents where volume profile support converges. Take profit targets, follow disciplined scaling. 20% at $3 securing initial capital. 25% at $5 capturing the previous all-time high retest. 30% at $8 because that's the 1618 Fibonacci extension where institutions typically take profits. 15% at $12.70 where extension clusters appear. And final 10% between $17 to $20 for tail risk upside. I'll trail stops as targets hit, and this requires active management, not set and forget positioning. Best case, Virtual breaks $1.90 with volume, retests it as new support, then executes a measured move toward $3 and $5, with Fibonacci extensions at $8 becoming realistic by Q1 2026. Base airdrop speculation drives user activity into the ecosystem. Agent commerce protocol transactions continue exponential growth, and the agent infrastructure narrative attracts institutional capital as enterprises accelerate AI deployment budgets. Worst case, broader crypto risk-off conditions emerge, Virtual loses triangle structure, and we retest $1 support, potentially declining to 50 cents where volume point of control sits. That wouldn't invalidate the long-term infrastructure thesis. It would create better reaccumulation prices. Timeline considerations. Short-term traders need the 190 break within 4 to 8 weeks. Long-term infrastructure investors focus on whether Virtual scales ACP activity from thousands to millions of weekly transactions through 2025 and 2026. If Agent Commerce Protocol becomes the coordination standard for autonomous AI economies, Virtual captures that entire value flow through token economics. That's where asymmetric upside lives. Virtual's protocol is building the infrastructure layer for an autonomous agent economy that's already generating measurable on-chain activity. The technicals show a validated triangle breakout above all major moving averages with Fibonacci targets extending toward $8, $12, and potentially $20. The fundamentals show smart money recognizing this as infrastructure, not speculation. Agent Commerce Protocol transactions accelerating, coordination layers operational, and base ecosystem dominance positioning Virtual to capture network effects. At 160 with defined risk at $1 and reward extending to 8+. This is an example of the kind of asymmetric setup infrastructure plays offered during early adoption phases. If this breakdown added value, punch that like button, helps the algorithm connect this analysis with others building data-driven strategies. Join my free Telegram for daily and faster updates. Link is in the pinned comment. I've been covering AI and DeFi infrastructure all cycle. Check those breakdowns on screen for more high-conviction setups. Never financial advice. See you tomorrow.